the emerging legal battles over carbon credit trading. Carbon credit trading is shifting from a niche climate tool to a high-stakes legal battleground. As markets scale, both compliance and voluntary, courts, regulators, and civil society are testing the integrity of credits, the truthfulness of corporate claims, and the enforceability of cross-border transactions. The result: rising litigation, sharper scrutiny, and a push toward clearer rules that can make or break the credibility of carbon markets. Why carbon credits are facing legal heat. Corporate claims under fire. Judges are increasingly skeptical of companies using offsets to market carbon neutrality or to dilute responsibility for emissions. Litigation is expanding, with many cases successfully challenging the adequacy and honesty of offset-based claims. Regulatory fragmentation. Carbon markets operate across jurisdictions with inconsistent rules, creating legal uncertainty around validation, ownership, and enforcement, especially in voluntary markets. Integrity and fraud risks. Questions about whether credits represent real, additional, and permanent emission reductions are fueling disputes, investigations, and reputational damage. Key legal fault lines. 1. Validation and environmental integrity. Validation processes, how credits are verified and certified, are under intense scrutiny. Courts and regulators are probing whether methodologies ensure additionality, permanence, and avoidance of double counting. Weak or inconsistent validation frameworks can lead to claims of misleading environmental marketing and consumer protection violations. Ambiguity in standards. Differing validation protocols across registries and jurisdictions create legal ambiguity, exposing buyers and sellers to challenges over credit quality and legitimacy. Litigation trend. Legal actions increasingly argue that offsets don't undo emissions, undermining corporate claims of climate impact and triggering consumer law and securities law risks. 2. Ownership and property rights. Who owns a carbon credit and the underlying environmental attribute can be contested, especially when projects span multiple countries or involve complex contractual chains. Disputes arise over title transfer, double issuance, and whether credits can be clawed back if validation is later questioned. Contractual clarity. Poorly drafted contracts that fail to define title, warranties on integrity, and remedies for invalidation are a common source of litigation and arbitration. Cross-border complexity. Credits generated in one jurisdiction and sold in another face conflicts of law and enforcement challenges, particularly in voluntary markets without harmonized regulation. 3. Misrepresentation and greenwashing. Companies using credits to claim net zero or carbon neutral face legal risks if those claims are deemed misleading. Courts are increasingly receptive to arguments that offsets don't negate emissions, and regulators are tightening guidance on environmental marketing. Consumer and competition law. Misleading claims can trigger lawsuits, fines, and reputational damage, especially where credits lack robust validation or are tied to questionable projects. Disclosure obligations. Public companies may face securities law exposure if offset strategies are overstated or not adequately risk disclosed. Compliance versus voluntary markets. Different risk profiles. Compliance markets, typically governed by statutory frameworks, they offer clearer rules but still face disputes over allocation, measurement, and cross-border recognition. Enforcement is stronger, but litigation can arise from regulatory changes and methodology updates. Voluntary markets, faster growing but less regulated, they carry higher risks of fraud, inconsistent standards, and contractual disputes. Buyers must rely on due diligence, warranties, and robust verification to mitigate legal exposure. How companies and investors can reduce legal risk. Strengthen contracts, include explicit warranties on credit integrity, title, and non-double counting, define remedies for invalidation, and specify governing law and dispute resolution mechanisms. Demand rigorous validation, use reputable registries and methodologies, require independent audits, and monitor for changes in standards that could affect credit legitimacy. Avoid overclaiming, align marketing with conservative, verifiable claims, disclose limitations of offsets, and prioritize direct emissions reductions to reduce greenwashing risk. Plan for cross-border enforcement, anticipate jurisdictional conflicts, ensure compliance with local consumer and securities laws, and structure transactions to withstand regulatory shifts. What's next? Consolidation, accountability, and higher standards. Legal pressure is pushing carbon markets toward consolidation of standards, stronger verification, and more honest corporate narratives. Expect more cases challenging offset claims, tighter regulatory guidance on environmental marketing, and greater emphasis on direct emissions cuts over reliance on credits. At the same time, clearer contracts and harmonized validation frameworks will become essential infrastructure for a credible, investable carbon market.